Jonathan, great to have you on the program for the panel today as well. Just give us your thoughts on inflation and the kind of liquidity that's going through the markets because of QE2.
Yeah, thanks, Brooke. Look, it is going to be quite interesting, and I tend to sort of agree with Phil because, you know, you've seen a lot of our primary input prices as a result of QE2 go through and trade on these highs. I mean, cotton, as we know, is up 100%, sugar, the like. So really the question is, will this stimulus and how will this stimulus be allowed to run through the economy? Because if primary import prices are very high, then people won't be about and can't afford to actually buy them, then it becomes a problem and we stall like we really have for the last 12 months.
Is there a question mark over whether this happens, or you think it's already underway, Phil?
I think it's already underway. Oh, sorry.
No, go for it. That's fine, Jonathan. Go for it.
Yeah. No, go right ahead. Go right ahead.
Okay. I'm still looking for this to occur because when I look at what's happening in the crude market, we're seeing a weaker dollar force crude to two-year highs, yet we're still concerned about demand. So in that respect, we're seeing inventories build, the price go up, who's going to afford to buy it?
Well, we did see a fall off, and I know, Phil, you'll say this is 1 week of data, but we did see a catalyst for those two-year highs overnight, being that drawdown in stockpiles. I mean, was that just a blip, or did the markets get ahead of themselves on that?
Well, I think they have to react to it, but I mean, what's happening is that we're seeing a major shift in the U.S. oil market, and we've really been seeing it creep in for the last 2 years. It's a major change. The reason why inventories fell, it wasn't because demand in the U.S. was, going through the roof. It's because our exports hit a record high, and our imports into this country probably hit, I believe it was a 4-year low. That is a significant change. You see, we have an abundance of oil. We have an abundance of refining capacity in this country. And right now, we're kind of picking up the slack for the rest of the globe. Our inventories, which oil inventories were at the highest level since the 1930s, our heating oil supplies probably at a 25, 30-year high. We're starting to supply disruptions in other parts of the globe. For example, the French strike, which caused a lot of exports from the U.S. So we're seeing a significant change. So I don't know if you can just look at the inventories and say, hey, demand is getting better, inventories are down. It might not be the case, at least here on this side of the pond.
Well, that's the thing. You did acknowledge, though, that exports are running hot. So that cooling in demand, certainly in the crude complex, where's the evidence of it?
I think when you look at, listen, there's no doubt the emerging markets are using a lot of oil, but I think what we've seen, in China this week is that it doesn't all go to production and usage. For example, we saw the oil exports in China drop pretty significantly, and what that means is that they have a significant surplus of their own that they can fall back on when they believe prices in the international market are too high.
Well, Jonathan, these oil prices are headed higher, and there's some fairly bullish calls coming out for oil once again. That seems to be back in vogue as everyone gets excited about the commodity spectrum. Do you think we're looking at a spike or a trend?
I think we're actually looking at a spike at the moment, Brooke, because when you look at where the demand is, and if the demand is coming from the emerging economies, then as we look at the data, things are cooling down. You do have what's China in terms of moving the interest rates up. I mean, the other good number we have, just to reiterate the feeling about this slowing down in demand, is obviously in the copper complex, where copper imports dropped 26%. So you can start to get a feel or a sense that if the emerging economies are trying to cool or slowing down, then demand perhaps and the price at these levels are not clearing through the economies on a profitable note. So we've got to see that adjustment. We've got to see adjustment occur. And for crude oil, I think we're looking at more of a spike. That'll be concluded if we see a break below 85 US dollars.
Phil, looking at some Chinese data out today, it's going to be interesting to see the flow through on this, with the expectations that consumer prices will be up about 4% in October. That compares with a 3.6% runaway in September. Are those rises going to be enough to really hit Chinese consumers and shift their spending patterns?
Well, I wouldn't go short, Chinese auto dealers right now. No, I don't think it is. But the trend is disturbing at this point because it doesn't shake them up. And, you know, the reason why I don't think it is partly it goes back to the beginning of the entire conversation. It goes back to the Fed and QE2. You know, the Fed is, in a way, exporting, you know, their problems to another country. And this inflation that they want, it's not a problem here in the U.S. As much, but it is going to be a problem in these emerging markets. What I don't like about this, you know, we're talking about balancing of the global market. That's going to be a term that you're going to hear for some time. We've been out of balance for some time, since this economic crisis began, probably before. You know, these rising prices in China and here in the United States, you know, it could have a very bad ending if it, you know, if they get out of hand.
But I mean, Phil, in a sense, what could they do differently? They have to manage expectations as a reserve bank.
Well,
they cannot just sit idly by and even just jawbone it. They have to do. They have to move on it.
Well,
if you're talking about the Chinese, absolutely.
Well, I'm talking about the Fed. I'm talking about the Fed. I mean, in terms of creating
the Fed, okay.
Yeah.
All right. No, listen, the bottom line is I think the Fed, you know, this was their only play, and you can argue whether it was the right thing to do. But I also think it was a message, Ben Bernanke's only message. I mean, Ben's like a man in the wilderness saying, hey, we've got a problem, you know, and everybody has to get on board. He can't expect the Chinese to stop, you know, manipulating their currency. He can't, at this point, expect our Congress here in the United States to get spending under control. So what other choice does he have? So he's going to go, you know, full steam ahead. Hopefully, this shock and awe, instead of shock and awe in the market like he's trying to do to the economy, maybe he'll shock and awe the Congress and the G20 to have everybody get their houses in order.
And Jonathan Barratt, your response as well?
I think when I look at what Ben's doing, you know, he's creating more money so that businesses can buy inflated primary inputs. Ben wants to have that inflation because it's the only thing that he can control. So he'll do it whichever way. So if he's allowing $75 billion to go back into the economy so that people can then buy cotton or shirts, which are going to have to be 100% increased in price, then he'll get his inflation. The question is, where do these prices stop? And where does the consumer stop actually having to buy it? And I think that, to me, is the question. Because in all this, we got to stimulate the economy, we got to stimulate the consumer. And if the consumer doesn't want to buy, then we got problems.
And this, I know this sounds like a stupid and really basic question, but I mean, here in Australia, our viewers will say, well, if you've got an inflation problem, you raise rates. I mean, obviously it's more complex there in the United States, but Jonathan, why couldn't they just do that down the line and they stop the Treasury purchases? I know that sounds a stupid question, but some people think that, you know, it should be a lot easier than it is. Yeah,
look, Brooke, the thing is you've gone from 5-6% down to 0.25%. So you've got to enable to attract investments. The big concern we've got is that normal economic concerns, debt concerns in Europe will see people go to the dollar by their own fruition. And if the dollar firms, then you will see commodity prices come lower. But yes, if interest rates moved up, people are going to say it's going to have an effect. I don't think it will. I actually think if interest rates are higher, then they've got room. But I think the concern, Brooke, is the deflationary problem, which the Fed doesn't want to sink into. And I think that's a big issue at the moment, and that's why Ben's looking at that inflation.
Right.
Phil Flynn, I think we're about to lose your line, so before we do, we'll thank you very much for your time today. Thank you, Phil Flynn from PFG Best in Chicago. Great to get him on board. And final thoughts perhaps from Jonathan Barratt, who can stay with us just for one or two more minutes. Jonathan, good to keep you on the line there. And just thoughts maybe for the day ahead as well with the retail sales, IP, inflation, fixed asset investment numbers out of China.
Yeah, look, I think that's going to be very interesting. They're going to be very interesting numbers. And I think you're going to find that they'll be on the higher end of expectations, and then we'll probably have to see some movement again by the central bank in terms of trying to cool things down. So it's going to be interesting. Let's see what it does to gold. Gold looks like it's found a little bit of a low, so maybe a push to retest those highs.
A call as well on the future course of the Australian dollar being quite susceptible with the jobs numbers out domestically. Is it a given we're going to see another build for this month, or do you think there could actually be a surprise pullback, Jonathan?
I think we'll be looking for, once again, a build. I feel that we're on a bit of a roll and a bit of a trend. So, and I think the optimism at the ground level is very positive. And I think that Aussie can head back to that top side again. It's had a bit of a correction, so let's see it head higher.
What are you basing that optimism on? The NAB Business Survey was doing anything but presenting a rosy picture. And speaking to CommSec earlier, their soundings on the ground really jitters is very much the thematic.
Look, I think, Carson, you can look at that, but we've got to look at our two-speed economies and what's happening. The numbers have always been volatile, there's no doubt about it, but, I think the Reserve knows, I think as a result of putting interest rates up, that employment is on the increase, and I think that's got to be relatively positive.
All right.
And one final question from me as well, Jonathan, is, we've seen this flurry in commodities, this great excitement, huge moves, big volumes, and yet equity markets, they're kind of stuck at the moment. Is there a disconnect there, or how do you read that?
There is a disconnect. I think what's happened on the equity fronts is that the stimulus has come through and people are marking in these, or trying to mark in these expectations. Certainly in the States that's the case. In Australia, the equity market just seems to be resting. But a lot of focus is purely on those commodities because the commodity prices just continuing to run. Should have a correction, but I feel that commodity prices just continue to look good in Australia.
Right.
I was just up north and everything looks very, very positive up there for the commencement of our wheat harvest.
What about just this idea of perhaps being on a knife edge, a disorderly sell-off for the A-dollar in spite of a good jobs number? Is it a give and a gain, Jonathan, that strength in jobs will automatically see buying action in our currency?
I think so. I think the Aussie, if we do get that strength in jobs, then I think that Aussie does head to the top side. I would note that the US dollar in itself has been pretty well bid for the last couple of trading sessions. So, there could be an initial correction there for the US dollar. But I think that Aussie does have a little bit of a low in place, and for it to try and test back through 101.
Those net long positions, though, hitting a 3.5-year high. So that specky component to the Forex market here, not something that worries you?
It doesn't. I mean, we've got that yield play, which continues to be very solid. We did have a reasonable bounce off the lows. I think if the market wants to break through parity, then we might see a little bit more of a correction through that 99.90 as people think that the run. We've just got to run with that. But at the moment, I think I'll see what the numbers come.
Jonathan Barratt, great to get you on board with Phil Flynn today. Thanks very much for your time.